Welcome to Inside is Capital. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. Joining me today is Michael Green, Portfolio Manager and Chief Strategist at New York-based Simplify Asset Management. Michael was previously Chief Strategist and Portfolio Manager at Logica Capital Advisors and has previously held senior portfolio management roles with Thiel Macro, Ice Farm Capital, Canyon Partners, and others. He's a prolific researcher and writer, has a huge and popular following on Twitter, where he tweets as Prof Plum99, and Real Vision, where he shares his thoughts and industry contacts in his Mike Green in Conversation series. Michael has presented his proprietary findings focused on the ongoing shift from active management to passive approaches to audiences that include the Federal Reserve, the International Monetary Fund, the U.S. Department of State, and dozens of other industry groups and associations.
This is the Inside is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Mike, it's an honor and a privilege to have you back. Before we get started, I want to ask you, what have you been working on lately and what's new with you?
Well, first of all, Pierre, thank you very much for having me. It's always a pleasure to come back and chat with you. This is a really interesting time period. I think that we're seeing a combination of things that I've talked about in the past begin to come to fruition. We also have a really interesting economic puzzle sitting in front of us, which is this question of, do we have the world's best telegraphed recession, or is this actually spurious based on the strength that we're seeing coming out of the employment market, et cetera? The quick answer is we don't know. And in the face of that, I think it's very interesting how passionate people are in every direction, right? Ranging from hyperinflation is upon us to we have a deflationary bust ahead of us and a Great Depression, to we're missing the opportunity of a lifetime to buy equities, or the idea that we're going to all freeze to death as global warming fails to keep us with our lack of access to fossil fuels. So there's just an awful lot of passion and debate that's making its way into the market that, in my opinion, is in an interesting fashion actually not really manifesting itself in general behavior. I mean, the more interesting thing to me is that we see incredible correlation between Bitcoin and Tesla and Bed Bath & Beyond and various other meme stocks.
Right.
They're all behaving in a very similar fashion, suggesting that this has very little to do with individual insights. Right? This has much more to do with kind of the macro dynamics and the macro factors that are in play. And yet everyone is kind of convincing themselves that they're behaving in a contrarian fashion, and I don't see a lot of evidence. So it's a really interesting time. I'd say I'm spending more time than usual trying to dissect the data that's coming out of Western government institutions. Many years ago, I think it was probably 4 or 5 years ago, it was suggested that the right approach, I forget who suggested this, but they ended up being very prescient. The right approach was for Western investors to begin to think about things from an EM investor standpoint, right? Nobody actually pays any attention to the data that comes out of most EMs on a government basis because we just know it's so deeply inaccurate. We don't pay attention to Venezuela's inflation numbers, we don't pay attention to Greece's employment numbers, even though they're slightly better. We certainly don't look to them as models of accounting probity. So when we're trying to understand stuff in EM, we have to first figure out if the data that we're looking at is correct, and secondly, establish kind of broad thrust pictures, right? Because we just don't have the detail. In the West, we have giant institutions that are built to provide that data to us, and we diligently pay attention to the Bureau of Labor Statistics release of employment information or the Department of Energy's release of energy data, et cetera. And the problem is when you inject as much volatility into the economy as we have over the past several years, the stability of those systems breaks down. And many of the modifications that were made historically to the data sets that we now see were actually designed to basically smooth out extreme information. There were, we introduced things like the birth-death model in terms of U.S. employment, precisely because we don't want to continually restate historical data and say, oh, guess what? We actually had new businesses emerge that weren't properly captured. So we introduced something like birth-death as an adjustment to that data series to try to smooth it out over time. But then when something super volatile like a coronavirus pandemic or changes in stimulus tied to, collecting tax credits for employees or PPP benefits, et cetera, we have to expect that those data sets reflect that underlying change in the regulatory framework, and that is going to skew all the data that we receive, right? My sense is that we're not doing a very good job of making those modifications. Right. I can share all sorts of data around exactly these components. It can be everything ranging from, oh my gosh, there's been a surge in, self-employed incorporated businesses. That's indicative of a growing entrepreneurial surge. No, that's not what it's indicative of. Actually, that trend began in 2016 when it became a requirement for Uber drivers and others who participate in the gig economy to actually establish tax dynamics.
Right.
That was a written component. So we see this data. It's very clear if we actually go in and dig out from the data what the changes were and how that's impacted. I'll share just an extreme chart that I actually been playing around with today. So this is looking at the explosive growth in business applications that you've seen, right? This is the business formation data. This is the business application data that you see in the data sets that are affecting the way the birth is reported. In 2021, in April, May of 2021, the Biden administration introduced the employee retention credit, which pays you up to $26,000 per employee for an incorporated business that is continuing to hire people. There's a lot of debate around the impact of this. If you look at the cumulative access business applications for 2021 versus normal seasonality, I personally detect a pattern. I'm not sure if I'm the only one that can see this.
Right.
But this seems very straightforward, that a lot of the data sets that we're receiving have been influenced by these types of policy choices. Understanding the implications of that is critical, in my view.
So this basically shows that the businesses that were applied for, it was for the incentive.
100%.
Yeah.
I mean, that would be my interpretation of this. Now, I'm going to lay it straight out there. I'm not an academic researcher. The Boston Fed has attempted to address this. They did not approach it in this way. They did a lot of what I think are incorrect analyses. To me, something like this is a very straightforward way of presenting the data that illustrates exactly what I would have expected. That could be confirmation bias, but I don't think so.
Yeah, not a coincidence.
It would be one hell of a coincidence, I think is the official term for it.
Right.
So that's the sort of stuff that I'm trying to pay attention to. And unfortunately, our policymakers, I think, are much less creative in their evaluation of that they're receiving. And as a result, we're hearing an awful lot of data from individuals like Chris Waller of the Fed, saying, well, everything's fine. I think it's great. There's no problems associated with it. And I'd be thrilled if I was wrong about the data in 2023 as wrong about the data in 2023 as I was in 2021 about the inflation data, because it'll be super easy just to cut interest rates and fix the problems. Well, again, every recession, every bear market that we've gone through in the past couple of decades, we hear this language of the pushing on a string because it doesn't actually work that easily, right? So, this is the sort of stuff I'm trying to pay a lot of attention to right now. And on top of that, of course, there continue to be the dynamics of the continued growth of passive investing, influence that has on markets, et cetera. So you asked me what I was working on. That's what I'm working on these days. It's really trying to understand this stuff.
Yeah, I think that that's sort of a good layup to what we are going to talk about. And which is to start the economic cycle. Having come from the options world and having held several leading roles as an allocator of capital, you've become an extraordinary observer of probabilistic outcomes, and you've become well known also for your meticulous thinking on markets and investment strategy. Have you come to a determination on whether or not the Fed is acting on poor data? And secondly, do you have a probability for when or if or both when the Fed will, if the Fed will pause or pivot, or if they're going to continue as Powell
along this path? A couple of quick things. One, I think it's been very interesting. You've seen the inflationary data, inflation really on a shorter term time horizon. If I look at 3-month annualized, or I look at the last 6 months, et cetera, the evidence is actually fairly straightforward that the inflationary pulse that had hit us before is now going away or is gone. In goods in particular, we're now looking at significant negative inflation, or what's called deflation. In many types of services, we're seeing a dramatic slowing of inflationary conditions. Rents, for example, are now down for the second consecutive month. Even though they're up significantly on a year-over-year basis. And what we don't know, and I just want to always emphasize that part, is we don't know what's going to happen next. But if we indeed end up in a recession, we indeed end up with the surplus it appears that we're going to have from a combination of single-family homes being purchased and contracted for rental purposes, and a continued and significant surge in multifamily construction, adds far more units relative to single-family home construction, at least on a dollar basis. Are we going to continue down the path of those declining? It appears that the answer is very much yes. Now the question becomes, what does the Fed respond to? And so you mentioned, the focus on the options market. One of the things that I tried to emphasize for people is you can use the structure of the options market to see what the market's paying attention to. For the past several months, the market has been placing huge premiums on the CPI prints, effectively saying this is what the Fed is paying attention to. We now have 2 consecutive months in which the CPI numbers came in basically, slightly worse actually than headline expectations, but was largely discarded, and the volatility on that was faded significantly. It's becoming increasingly difficult to identify and isolate situations that cause the markets to move in a significant direction. And I would just suggest that what that's telling you is that the markets largely think the inflation story is over. Now it just becomes a question of, does the Fed actually start to follow through with cuts at some point? My fear as it relates to all of this is that by hiking as aggressively as it did, what the Fed actually did was destroy demand, not so much on the consumer side, but on the investment side. The evidence of that is relatively robust. There are some areas where you're seeing evidence of increased expenditures, but certainly relative to what we would have expected, rig counts are going down, not up. We're, despite the fact that everybody's worried about an oil short, we're seeing evidence of non-residential construction, particularly in commercial real estate, is being absolutely hammered, et cetera. The reason that I highlight that is the fear that I have is that the Fed has basically pushed through a solution that may contribute to deflationary conditions over the next year, but as we emerge from the recession, ultimately expose us to the same shortages, if not worse, than we had going into the recession. So I think what's unfortunately about to happen is that we've introduced volatility into the system. You see this with the extreme move, extreme levels of the interest rate index, the move, for example, that just say that, they've made the problem worse. And that's largely what you would expect, right? And if you think about the person who's supposed to take away the punch bowl, and then you add in repeated errors as they, continuing to stimulate in 2021 instead of reducing stimulus in the face of things like the ERC that I just highlighted. And now trying to slam on the brakes on an economy that's already slowing, all you're doing is increasing amplitude of the moves, become a pro-cyclical volatility contributor as compared to a volatility reducer. My gut tells me we're going to wake up and find that, that's what our world looks like over the next couple of years.
So, in that respect, you're and at the same time, the narrative, of course, is that the Fed is that the inflation story is over and that the Fed will turn dovish, or there's an expectation or a hope that the Fed will pivot and become dovish. Is that likely? I mean, what is the likelihood of the Fed?
Well, so
that's the way the market's behaving, right? Yeah.
Yeah. I mean, let's just run through the math, right? So first, the Fed has to slow the hikes.
Yeah.
Right. And the Fed has to decide that they're going to stop the hikes. Then the Fed has to decide that they're going to reverse the hikes. And this is before we even begin discussion around QT, although they have indicated that they're now beginning to consider separating those two, that they're willing to consider policy dispersion in terms of the underlying dynamics, right? They've resisted the idea of pressing the brake and the gas at the same time. That's been an area criticized. It sounds like they're starting to reconsider that, which I would consider to be a relative positive. But exactly like in 2021, where there was an element, we're going to display conviction, right? It wasn't quite George Bush, read my lips stuff. Powell was very much, as late as November of 2021, we're not going to be hiking interest rates for a long time. Right? Maybe a little earlier than that. I'm thinking the last time he said that was probably September of 2020. Yeah. Man, if you listen to the Fed, you got destroyed. Right? So what's happening now? Well, the big difference is that listening to the Fed would basically involve, saying, I'm not going to buy bonds. Maybe you won't get destroyed by not buying bonds. It strikes me that if anything, that the market is certainly telling you that the Fed's going to be forced to respond to it. And I know anything about the history, that they'll wait until the last possible moment and then overdo it, and we'll go through the whole process all over again.
Well, yeah, they don't want to be, the Fed that certainly doesn't want to be too early. And I mean, they're almost always too late.
They almost by definition have to be. Right?
Yeah.
They don't, they were to truly be proactive. They were to truly decide that they were going to start tightening when, people are starting to get boisterous at the party. In other words, taking away the punch bowl. The political outcry would be extreme. We saw this under the Trump administration, where the economy was clearly tightening. There were clearly elements of inflation beginning. We were seeing wages already start to rise. And in many ways, I just would suggest that what happened in 2020 and 2021 was an extension of that. We started the recession. We didn't allow it to finish. We then exploded people's purchasing power. And guess what? We found out that the shortages that had begun in 2015, 2016, 2017 began to manifest themselves in earnest relatively quickly. Again, I think we know that the institution itself lacks the courage to be in a truly contracyclical fashion.
So, Mike, are we actually in or about to go into a recession?
So my analysis would suggest that we are in a recession already.
All right.
There's a couple of unique aspects to this recession that in many ways are almost a mirror image of the 1960s.
What I find interesting in advance of our discussion is that the market seems to be on a hair trigger about what the Fed will do. And so right now, the market's behaving very positively, or has been rallying. I'm curious to know if that's short covering, especially, the behavior of tech stocks the last few days.
Yep.
And, so all those shorts that were out there on technology are covering because of the Fed sentiment. I have a hard time believing that it's investors coming in and bottom fishing. And, especially given the year that it's been. And so the market seems to be behaving as though it expects the Fed to pause, and maybe even pivot. And your point's well taken too about the amount of time that it will actually take for that to happen, even in if the circumstances present themselves, how long it will take for the Fed to, cover each step of its actions. Slowing down the rate hikes, stopping the rate hikes, and then actually instituting rate cutting. How many months are we talking about? If it was to happen today, if the indications came today, how long would it actually take the Fed to turn around?
Yeah, I mean, the quick answer is it depends on the severity of what comes next, right? The markets were to crash, if we were to see a severely adverse end expectation, as would respond relatively quickly. It's very hard to expect the Fed to respond aggressively when you're seeing, metrics like financial conditions ease. And just, remember what's incorporated in financial conditions is literally an expression of, if I look at the GS model, for example, the credit spreads and the VIX, right? Those are the two components that really contribute to financial conditions. Both of those, the VIX has fallen and credit spreads have tightened. So everyone is convinced that everything is fine. I wanted to show this chart very quickly here.
Yeah, please.
One of the things people spend an awful lot of time thinking about is this question of how bad can the unemployment story. One of the things that people forget about recessions that we've seen recently is that the severity of that recession is often a function of who is trying to get into the job market as much as it is who's already in the job market. So the story of the 1960s and 1970s, where you saw rising unemployment, even in the face of inflation, that was on the back of an incredible surge in the number of possible employees coming in through the baby boomers, rising labor force participation for women, aging of the baby boomers who were born basically starting in 1945. By 1970, they were hitting 25 years old, starting to meaningfully enter the labor force. That, of course, then contributes to a rising number of entrants. The millennials were an echo boom, exactly as we described, and that happened to hit in the aftermath of the 2008 recession. And as a result, we had all the stories about underemployed millennials who were college graduates, et cetera. That's now going away. We're watching that dynamic retreat, very low rates of labor force growth. That has all sorts of negative implications, but it also means that unemployment will less likely to rise to the levels that it did in the global financial crisis. Instead, this is probably going to look a lot more like 2000 and 2003 recession. Really, that started in 2001. And, maybe we'll see 5-6% unemployment. My pushback to that sanguine view, however, is my big fear is that we're going to lose a lot of people who are going to have a very extended period of unemployment as a result. And that, unfortunately, is a recurring pattern. There's been a lot of excitement articulating, the layoffs that have occurred in tech, people have gotten hired back almost immediately. That's inevitable at the start of the recession. Once it begins to kick in and people suddenly start saying, oh, maybe I should hold off on hiring because maybe business is going to slow down, that reflexive dynamic. Once that really starts to kick in, it becomes harder and harder. And the other thing to remember is that those technology employees tend not to be general purpose. So like I can hire a gardener and they tend to be general purpose. I can hire a factory line worker or a steel worker. They tend to be general purpose. Can be assigned, the union would allow people to be assigned to different locations. If I have a, particular expertise in programming language and voice recognition software or image recognition for Facebook, my skills are fairly narrow and fairly defined, and my employment expectations in terms of compensation are likely quite high. And the data suggests that under those conditions, what we're most concerned about is the duration of unemployment that emerges.
And that's
right in the aftermath. And that's I think exactly what we're gonna see. We've seen every single cycle have higher and higher levels of longer and longer periods of unemployment. Looks like we're going to do the exact same this time around.
yeah. The Fed is basically not paying attention to all the data or not enough data. They're not looking deeply enough at the data, and they're acting on a very sort of superficial set of data. They're not understanding that they're creating the problem. They're creating a bigger problem than they're solving.
Um, well, I think so. So I think there's two separate components there. One, I don't want to imply that the Fed is doing. It's not like the researchers at the Fed are intentionally doing a bad job, right? They're
Yeah, no,
doing
they
the
think they're
best
doing
that
a great job.
right.
Yeah.
They're doing the best that they can, and there are very legitimate reasons why they could disagree with my analysis, for example. Right.
Right.
I don't. Economics is a social science. It's not a science. I can't run repeated multiple experiments to test to see what happens if I introduce the Employee Recovery Act under normal conditions versus post-pandemic. There's no way to run that experiment. There's some clever attempts at ways to do stuff like that, but you're never going to get. There's also just a very deep fundamental difference, I think, in the way that macroeconomists in particular approach markets and the way that I tend to approach them. We tend to approach things from the standpoint on a macro side as everything's in aggregate. The workers are interchangeable. What I care about is unemployment, right? In all capital letters. You mentioned that you watched the Ben Hunt example. Ben Hunt is famous for using that type of dynamic, right? Bitcoin in air quotes, or unemployment, or it's the economy stupid sort of stuff, right?
The performative stuff, yeah.
Right. And so unemployment is one of those things that is by definition performative in many ways, because if you're not unemployed, you don't really care, right? You care. There's the expression, it's a recession when your neighbor loses their job. It's a depression when you lose your own. We all care about our own job and what's going to happen to us.
Right.
Unemployment, as I mentioned, has unique characteristics to it. I have a very esoteric degree and a specialty in one particular area. I don't actually expect to be frequently unemployed, but when I'm unemployed, I can be unemployed for years, right? On the flip side of that, if I have a high school education and I work as a grocery clerk, I can expect to be unemployed a lot because various changes in purchasing patterns and any form of economic slowdown are likely going to reduce demand for my services. So I'm used to moving in and out of unemployment, but I don't expect to be unemployed for a very long period of time, right? Those two simple differences can have very meaningful changes in how you want to construct policy. And our economy, by and large, has moved from one in which people are generally low skilled with general application to their education and skill set, to very specialized, where the latter is much more important. You screw up and destabilize that very specialized economy, the implications can actually be much worse, even as you feel protected because people, accumulate surplus under that model for a variety of reasons. I mean, again, the simplest one is if I'm getting paid a lot to be the voice recognition engineer or the troublesome COVID reporting engineer at Twitter, I'm getting paid a lot. I should theoretically save a lot of money. I can look down my nose at people who accumulate more than a couple of weeks worth of emergency funds.
Right.
But part of that is because I recognize that the surplus that I'm accumulating is unique and very and potentially required because I'll have this long period of unemployment. We don't tend not to take those things into consideration when we're designing these policies. There's a very real chance that the Fed is destabilizing, as I've highlighted.
They're underestimating the disinflation that's
built.
I
would suggest that they're underestimating the pressure that can be created by causing disruption in an economy with those characteristics.
Interesting. I thought it was interesting when Eric Basmajian, who you spoke to recently, mentioned that, the economy was already in a state of disinflation just prior to the breakout of the war in the Ukraine, and that was a disruption that disrupted the economy largely in the form of by introducing, as an exogenous event, a substantial amount of inflation because of the disruption that it was causing.
Yep.
And so I wonder, I mean, now that that's all, now that the Ukraine conflict is pretty much baked in, I wonder, are there any other wild cards that could delay the Fed from standing down or pausing and subsequently cutting? Is there anything in there? Like, I think there's been some talk about China reopening as a potential wild card and inflation volatility wild card that could further delay plans at the Fed, if there is plans at the Fed of pausing.
Well, I mean, the quick answer is, if the Fed chooses to pay attention to it, then of course.
Yeah.
If it actually occurs, then of course. China at least indicates off the top of its, China indicates that its population has significantly increased its net cash savings. Deposits are theoretically up. That creates conditions under which, if they were to truly reopen and liberate the individual members of their society to do what they wanted to do, we could very well see a surge of purchasing activity emerging from the Chinese. I'm very skeptical of both that data and of the reality of that being allowed to happen, but you absolutely have to consider it. And I think Eric brings up a really, really valid point by highlighting the dynamics of Ukraine. We almost certainly would have seen inflation retreat much earlier had it not been for Russia's invasion of Ukraine.
Right.
I personally fail to see how Russia's invasion of Ukraine has anything to do with U.S. monetary policy, at least in the traditional sense. And as a result, why would we react to it by hiking interest rates? I mean, let's stop and think about the stupidity of this. We are in proxy war with the Ukraine, and we are doing everything in our power to raise the cost of financing any activity that we're engaged in from a government standpoint. It's just absurd. It really is. When we went into World War II to hike interest rates to try to slow the economy down so that we would reduce inflationary pressures, because they absolutely existed. No, of course we didn't. Nor did we in World War I, nor did we in any other period in history. I mean, this is a really unique, exceptionally strange behavior that I would liken in many ways to our response to COVID, where we know the right protocol for how to handle a novel infectious respiratory disease. We actually know how to do that. You isolate the vulnerable, you protect those members of the population, and you encourage everybody else to be thoughtful in going about their daily lives. Nowhere in the rule books does it say you shut down the economy. Otherwise, when you're fighting a war, please find me where it says in the rule books to hike interest rate, because you can't.
Yeah. So, Mike, if it wasn't for the Ukraine conflict, Russia invading the Ukraine, would inflation have, would we have had inflationary volatility? Would the Fed's actions have been, like, if it wasn't for the war, what do you think? Do you think that we would have had a bout of inflation resulting from supply chain disruptions that were already happening prior to the Ukraine conflict? I mean, would the Fed have been, given the impetus to hike if there wasn't a war in the Ukraine? So if you take the war out of the picture, like it didn't happen, how much of what how much of the
first, I think the counterfactual is very, like, you're asking me for a counterfactual that's really hard to see with that.
Yeah.
The quick answer is I believe we would have had much less inflation, although I think that most of that has already resolved itself. We
Okay,
see that in
so
oil prices having retreated, natural gas prices for the most part. It's had a longer term impact. Europe has had here, and Japan as well, where they for LNG with Europe, those become issues. In the United States, it has some impact because the natural gas that was stranded in the United States is now available for export or increasing available for the export. That raises prices for U.S. citizens, with that surplus being transferred to the Europeans, Asians, and to a lesser extent or to a greater extent, in energy companies.
so
You know,
is it correct to say then that your opinion is that the Fed has overreacted, completely overreacted?
I think the Fed is completely overreacting. Yes.
Okay.
And to be fair, I think
Yeah.
the Fed, if I'm being completely fair to this, the Fed had no way to overreact or underreact given the magnitude of the changes. Right, like one of the two was going to happen, simply because so much volatility has been introduced. Right, we had a global pandemic in which, in a totally unprecedented manner, we shut down the world's economy. How do you respond to that? I don't know.
Yeah.
I mean, I'll just be really straightforward. I don't know the right way to respond to that. Right.
I mean, under normal, yeah. I mean, all on its own, without any intervention, that would have been a completely deflationary bust,
Correct.
right? So there's the stimulus. There's an overstimulus response, fiscal stimulus response, money being put into everybody's bank accounts, companies being funded for staying open and running their staff out of their homes. You know, the stay-at-home economy, all of that.
Yep.
But to what degree? So what you're saying is that fiscal stimulus, the overstimulus that was provided during the epidemic, during the pandemic, was largely working itself out.
I mean, there's almost no question that is true.
Yeah, and that's evidenced by the savings rate.
Yeah, well, the collapse in the savings rate afterwards.
The collapse in the savings rate.
Yeah,
so basically, I mean, Americans, North American citizens aren't sitting on bank accounts flush with cash right now. From that,
no, Americans are not sitting in bank accounts flush with cash. There is a subsegment of American population that is sitting on accounts flush.
Definitely.
That tends to be the subsegment of the U.S. population that was able to profit either through accepting PPP loans that were then forgiven, or taking advantage of things like the employee retention credit to radically lower their costs. We've seen the corporate sector and those that are tied to that benefit tremendously. Now we're seeing the reverse side of it.
So I want to get to a point where it feels like the market, or those of us in the market, however you want to define that. I mean, we are the market, right? And that we believe in the paradigm that bad news is good news. That we believe that a recession will lead to lower interest rates. Ultimately, that the Fed will cut in the, once they have the evidence that we're in a full-blown recession of some kind, whether it's a deep one or a shallow one or mild one, that the Fed will cut. But the circumstances of the recession is not good news. So I mean, investors look at the equity market and they think automatically that, if we return to a lower rate environment from the terminal rate of 5% to some lower rate, that will be favorable for equities. Correct? Is that? Is that the sea view?
Well, it's not my view, but
But there seems to be a positive outlook from the bad news. That
I would
if,
just say that that's a function of narrative being
yeah,
developed in response to outcomes. Markets
right,
have the Russell 2000 has not declined since 2021, basically. 2022, I'm sorry.
yeah,
It's basically gone sideways. Many of the junk-oriented companies, those that are heavily exposed to high-yield debt, have gone sideways, since the start of the quote-unquote bear market that we've experienced. Um, and we've seen prices generally favorable and positive on a year-to-date basis. Just to toss simple examples out, the Russell being up somewhere in the neighborhood of 7% a year. We have to construct a story that explains it. Otherwise,
right.
we're nihilists. That's just the way the human brain works. We have to be able to explain why something occurred using something that looks kind of like facts. So if the markets are up, we tell ourselves, oh, that's because, the Fed is going to have to respond, rates are going to have to cut, and therefore that's positive.
That's going to relieve the pressure on the carrying costs of
Right.
companies.
Let me flip that on its head for a second and say,
Yeah.
I don't think that has anything to do with it. Carrying costs have continued to rise. The cost of margin has become increasingly difficult. We're not seeing any evidence of a return to levered investments in stock markets. We're seeing I wrote about this in my Tier 1 Alpha note earlier. The dynamics of margin are not confirming the increase that we're seeing in the rise in securities. What is happening is that the increase in interest rates are no longer affecting the bond market. First, gotten far enough into this process that the bond market is basically able to go sideways. All of a sudden, that means that if I'm running a portfolio that is balanced with bonds and equities, I don't have to worry about selling equities every time bonds go down, so I can maintain the balance in my portfolio.
Right.
I just told you there's no fundamental signal in my model of the world. which
Yeah.
understand makes me sound a combination of insane and dismissive and everything else, but I simply think that's the way the world works. If you're an investor in a Vanguard target date fund, did at any point you call up your advisor and say, you know what, I really want to increase my allocation to these? Oh, does it automatically. And it does it on very simple rules that are set in place already. We've seen all this behavior built into the response fund. And so, forgive me when I'm dismissive when people say, well, here's all the reasons why it's happening. It's like, I don't really buy it.
Yeah. So all these trades that are happening, a lot of trades that are happening in the market are programmed.
A lot of the trades are programmed, and then
Yeah.
another batch of trades are forced in response to those programmed trades. Right. So if I'm running a short book and I happen to own a name is thinly traded, possibly over-shorted because everyone is extremely confident that it's going to go to zero. Let's call it Bath and Beyond, for example.
Right.
That stock can go up 500% as I'm forced to cover into a market in which very few people are going to sell them.
Yeah, and we've seen that.
We've seen exactly that. Anyone
Yeah.
who's holding Tesla at 400 is not suddenly on the basis of business prospects decide to sell to you at 100. Right? They're like their view. We've seen this in all the headlines over and over again. They're like, this is the buying opportunity of a century. Now, admittedly, I don't have any money left, but at least I'm not going to sell my Tesla shares to you. Well, if I need to cover my Tesla shorts and nobody wants to sell to me, then what happens to Tesla prices? It goes up. As Tesla prices go up, what does that cause the person who might have a little bit of extra money left? $85 didn't deploy that into Tesla. At 100 said I'm not selling. At 125, they're suddenly saying, see, I told you Tesla was fantastic. I'm going to buy. And I think that largely explains the behavior we're seeing.
And how much of the behavior of the equity market is a reaction to what looks like smart money moving in and out? It looks like. I mean, I'm just talking about the illusion. Like when you see technology, tech stocks rising the last few days, off a bottom, not the bottom, but off a bottom. Uh, the narrative coming out of the networks, out of the news, the financial news networks is oh, tech stocks are rallying today. That somebody came in and did some buying, but they're not necessarily identifying it as short covering because there was a turn in sentiment on Friday.
Yeah, I mean, I'd say that there's, I think the right way to say it. We always need a story.
Yeah.
Human beings remember for thousands of years, we believed a story, some small fraction of the US population still does, that the earth was flat, it was a disc, and that the sun rose in the sky because a golden god rode his chariot, with fire-breathing horses across the sky on a daily basis, right? We believed that type of stuff for thousands of years. So for me to turn around and say to you, why are you surprised when I tell you that people make up stories for why things go up? Because it sounds dismissive to say something as absurd as the buyers were more aggressive than the sellers, right?
Yeah.
Like that just
Yeah.
feels silly, right? Feels that I haven't done my homework, but that's what actually happened. And so the aggressiveness of that buying plays in. Is a short being forced to cover, that's about the most aggressive buyer that you can possibly find. Because
Right.
they don't want to do it, they don't want to do it, they don't want to do it. Oh my God. A options market maker is a very aggressive, non-economic player. They could care less what the actual value of Bath and Beyond is. They just want to make sure they're collecting the premium that you're paying for that option. So they will delta hedge their book on a regular basis. The stock starts going up, there's short calls. Guess what they have to do? Buy shares.
Yeah.
They stop and check the 10K of Bed Bath & Beyond and go do a field trip to the stores and say, gosh, it looks like they've really got a fantastic surplus of fluffy Turkish towels. No, they would never do that. They'd say, damn it, just delta hedge.
Yeah.
And so that's the behavior that is driving markets today in my analysis. Now, does that mean everybody's behaved that way? No, of course not. Super smart individuals that I know who really dedicated and hard work on the fundamentals and absolutely believe that it gives them edge over normal investors.
Right.
Right? It's just a question of, is that edge enough to offset the costs associated with the individual security risk? The evidence is no.
So what's your, Mike, having said all that, what because I didn't actually ask you the question, but what is your actual outlook for equities broadly, and are there any segments of the equity market that you do like, either from a factor standpoint or sector standpoint?
Yeah, so it's interesting. I mean, I just took off my positions in emerging markets, and I'm now really for the first time in my portfolio is running what I would describe as broadly a net short portfolio. I'm not totally net short.
Okay.
I'm skewed in that direction, more of a credit than anything else. I think that we're going to have a meaningful profit recession of us. I think that the economic conditions are much worse than people think from the headline. And unfortunately, for reasons that I just shared with you guys, things like the change in unemployment tied to entrance, I just think a lot of the data sets that the Fed is looking to provide them with guidance are going to lag even more severely than they have in the past. So the Fed is ignoring weakness in the housing market because it continues to see strength in the employment market. In the employment market, I think the technical term for it is just bullshit. Don't think we're actually seeing that. If we're looking at things like full employment using the household survey, which is proven more accurate in most turning points, we haven't seen full-time employment grow at all.
Right.
Still sitting at 2019 levels, despite the fact that the population has expanded, the labor force has expanded, et cetera. Right? The rates of unemployment, while low for those with college degrees, is roughly 50% higher than it was prior to going into the pandemic and roughly doubled the level that it was going into the 2008 recession. Again, those who have college degrees tend to experience longer periods of unemployment once they become unemployed. So if anything, the risks that I see around this are that we have shortages in traditional jobs that have driven unemployment, whether those, the low skilled jobs, the line workers, et cetera. We can't find those people. That's a genuine shortage. We see this
Right.
in data sets that look at the difference in what's called the beverage curve. I'll actually pull up a chart and show it to you guys in a second. We have a messed up system that's likely to lead to a two-speed economy, but the ultimate answer to that is if we force this issue, we'll end up with an economy at a lower node, effectively a lower equilibrium. Not that there really is ever equilibrium in an economy, but we'll end up in a worse place than we otherwise would have needed, and that upsets.
Yeah.
There's needless loss of human capital and human potential when those conditions emerge.
So overall, the long-term fundamentals of the economy will deteriorate to lower lows.
Because the policy choices we're making now
Yeah.
appear designed to send us in that direction. Or designed is the wrong term, but appear likely to send us in that direction. On the flip side of that, I'm also going to say, though, just like if you looked at the U.S. economy in the late 1850s, right? So the discovery of oil at Spindletop is just about to occur. We've suddenly discovered that there's an alternative source of energy that we call oil versus coal or whale oil or, et cetera, for, lighting lamps, engaged in lubrication and everything else. All of that was directly ahead of us. And we would have looked at the economic conditions and said, oh my God, they're terrible. They're so terrible. We're going to, tear ourselves apart at the seams. On a country basis, we're going to lose 600,000 people in a population that, that would be the equivalent, I believe, today. I think the population that was about 35 million. So we're talking somewhere around 6 million people would have been killed in the equivalent of the Civil War.
Right.
Oh my God, this is the worst thing ever, followed by one of the most incredible growth stories in history. I think there's actually something kind of interesting along those lines. I'm looking at innovations that are occurring in areas like automation, in things like artificial general intelligence, or in particular, these large language models, et cetera, that are suddenly introducing the prospect of force multipliers that allow individual human beings to do things that they could have never imagined doing before.
Right.
My wife is a teacher. I'm trying to encourage her. She works with special needs, and I'm actually trying to teach her to encourage her to incorporate things like ChatGPT into lesson planning, because for the first time, you're looking at a situation where a kid who has a genuine learning disability actually has the potential to produce a great essay.
Right. Just by a few prompts.
Just by prompting appropriately. Now, you have to ask yourself, what is the objective? Is the objective to take a kid that has an 85 IQ, and I'm not implying that IQ to the vast majority of our students, I'm just giving the example. Is the objective to take the kid with an 85 IQ and turn them into somebody who on their own can write paper from somebody who has the equivalent of 115 or 125 IQ? Well, if that's your objective, you're an idiot. You can't. But suddenly I give you a tool that allows you to do it.
Right.
Go back 200 years in history. If I needed to move a very heavy metal bar, who did I need to have? I needed to have the strongest person that I could find on the unemployment line. Now, if I want to move a really heavy metal bar, I get a crane. And the person who's sitting in the crane doesn't have to have any physical strength whatsoever. So we're talking about introducing those same sort of capabilities on the intellectual side that allow knowledge workers to expand dramatically, raise the output potential for everybody. And that's what living standard increases are all about.
Yeah. It's actually, I mean, bringing up ChatGPT, it's remarkable. I mean, what it's able to do in terms of, like, for example, if you're a student and you don't know where to begin, where you're stymied and you don't know where to begin, writing an essay, at the very minimum, you could ask it to produce an outline for you. Or I mean, at the maximum, you could ask it to write the whole thing for you and then work off that. It's an incredible, it's both scary and fascinating at the same time.
Well, it is. It's both scary and fascinating. would encourage you to just change your language slightly. And
Yeah.
it's not incredible what Chat GPT can do. It's incredible what we can do with
What we
Chat.
can do with it. Exactly. Yeah.
I think it's really important that people embrace that. I mean, just stop and remember, you and I are roughly the same age, 26. And if you think back to the lament you probably heard in grammar school and high school, it was the math teachers. Oh my God, nobody's learning math. All these kids are using these calculators or these computers. We're all totally screwed. Nobody's going to know how to do math. Look at the world we inhabit today. It is so math dominated. And the reason why is because we can do things we never could have imagined doing in math before because we've enhanced our brain.
Right.
We introduced a partner in the form of the computer that is natural math language based. They just natively do it better than we do. That's the way that they are wired in a literal sense. And now all of a sudden we're talking about introducing tools that allow us to expand the same thing from a vocabulary or communications or imagination standpoint, etc. You a perfect example. I don't know where to start in my essay.
Yeah.
I don't have any idea what to write about. Hey, Chat GPT, here's the question I've been asked. Can you suggest 3 topics? Did I cheat? Only in the most ridiculous sense of the word.
Yeah.
If I ask Chat GPT to rewrite something for me so that it reads better, did I cheat? No. Only in the most ridiculous sense of the phrase.
Yeah. No, in reality, you took advantage of a tool
Correct.
that is
It's no
now
different.
available.
It's no different than people looking at, how we would construct the pyramids and say, yeah, but you can't use modern technology. Why? Why would you want to do that? Like,
Yeah.
fine, let's rebuild the Empire State Building, without using modern technology. Why? That's stupid.
I see what you're getting at. I mean, I think the bottom line is that now our children have the opportunity to stand on the shoulders of a giant.
Absolutely
and-
correct.
and-
By the way, that is the history of technology.
Yeah.
That is what technology actually means. That's why the written word was such an extraordinary force multiplier, right? And the
Yeah.
introduction of movable type and the expansion of the availability of the written word, and then the increase in the number of people who could use the written word, what we call literacy. All of these things define and change behaviors because they allow us to stand on the shoulders of giants. If I'm spending my childhood figuring out how to carve a road through the American wilderness so that my family can transit across North America, in a Conestoga wagon pulled by oxen, I'm not available to figure out how to create something like TikTok. I'm not available to figure out how to create something like something stupid, emulsion blender. Well, who the hell cares about an emulsion blender? Well, if you want to try certain types of food, if you want to have a really creamy butternut squash soup,
Yeah.
you have to have an immersion blender. You have to have these things, right? They each create their own characteristics. I've talked with my good friend Josh Wolf, and I often reminisce about TV shows from our childhood. There was a TV show called Connection by James Wilson. It was based off a book and turned into a series by the BBC that highlighted that all of these things build upon themselves. They're serendipitous. We're just talking about a world 10 years from now where increasingly I'm looking at it, this could be really cool. It's an extraordinary thing to think about taking a kid with an 85 IQ and allowing them to write papers the equivalent of somebody with a 125 IQ. And the person with a 125 IQ is not going to experience the same benefit, right? They're not going to go from 125 to the equivalent would be going, up an additional 40 points. They're not going to go to 165. They might go to 130. And that's huge improvement.
There's obviously some very positive, maybe potentially gigantic outcomes that will come of it. What does that mean for the economy, though?
Well, again, it depends. Right?
I mean,
screw it up because we're fighting the last battle. Means it's not going to be nearly as good. Right? If we get it right,
is it potentially deflationary? I mean, the productivity gain
I think everything is. technology by definition is deflationary in some ways and inflationary in others, right?
Right.
Figure out a way to use copper to send electrical signals. Is that going to lower the cost of copper? No.
No.
Is it going to lower the cost meaningfully of a stamped envelope delivered over the postal service? Oh.
Yeah.
Is it going to lower the cost of communication? Yes. Right? So
Yeah.
technology works in very unexpected ways when we talk about deflation. If we don't incorporate communications and we measure the cost of stamps, envelopes, and delivery and the cost of copper in our CPI, then the answer is no, it's inflationary. If I'm properly defining it in terms of the basket of goods and services that I'm purchasing and the expansion and improvement of those by collapse in inflation costs, then yeah, it's hugely deflationary. But again, it depends what we measure. I actually just wrote a Substack on exactly this. What we measure meaningfully affects the way that we think about that answer.
I'm going to have to read that, Mike.
Yeah, you can pull up my Substack. It's linked on my Twitter profile.
So, profit recession, and that profit recession, what does that ultimately mean for equities? That's a negative for equities. You're in a near net short position.
Yeah. So I mean,
so you're buying insurance.
Negative. I'm negative on equities for two reasons. One is if we see an increase in unemployment, in particular, if we see an increase in unemployment amongst those in the plus sector, that dramatically reduces the quantity of capital that's available to purchase marginal equities or any asset for that matter.
Right.
That plays directly into my theories around passive and how that can influence markets. The second thing that concerns me is that increasingly people are looking at the level of interest rates and saying, thank you very much, that's enough. And if we end up seeing people switch their focus on, we end up seeing people switch their focus away from equities and towards income, and everything ranging from target date funds on down have increased their equity allocations over the last decade. If we see any reversal of that, that could actually be negative for equities, which is kind of the underlying model that I'm focused on. The last thing that I would hit on exactly that dynamic is this issue of, what type of equities do people end up buying, or what
Right.
do they start to look for out of equities? And it's very hard to imagine we're looking for the same degree of innovation and disruption that we told ourselves the narrative last time around. Suggests that more money is going to be piling into good, safe stuff, and less money will be available for the sort of speculative dynamics. That has negative implications for everything from crypto to technology-oriented, venture capital employment, et cetera. So those are all things.
What's your view on fixed income?
So the way I describe it is that I'm renting fixed income. I think the front of the curve is relatively attractive. I agree. Blanchard just came out and said, I think secular stagnation is still here. I think he's broadly correct. Interest rates are likely to remain low. I don't know if they're going as low as they were before, and I particularly don't know about the back end, because I argue that the Fed, among many other damages that it's done, has now destroyed, at least for a subsegment of the population, the idea that bonds are an enhancement to a portfolio, increasing the number of reasons why people would want to own them. So I do think that there's been some meaningful structural damage that's been done to the idea of bonds as an asset class,
Right.
playing a certain role in the portfolio. It just suggests to me that fixed income is less attractive on a long-term basis, but on a short-term basis, I think it's really interesting.
Are there any specific areas of fixed income that you find attractive? I mean, there's a lot of talk that this could be a big year for fixed income. I think we've already seen a retracement in long yields from their.
Yeah. So that's exactly my fear is we've seen a significant retracement in the long end. 10 has gone from almost 4.5 to 3.5.
Right.
Does it go to 2.5? Probably. Does it go to 0.5, I find that unlikely. Do I see the 2-year potentially going to 1 or 1.5? Yes. And so I'm much more interested in the front of the curve. I'm much more interested in the idea of a steepener finally. I've resisted steepening for a very long time. That ended up being the right call. But my basic argument would be something along the lines of, I think that we're likely to see a rally at the front of the curve. So 2-year bonds look really interesting to me. And we'll see some participation on the back, but I think much less. And so you'll see the curve steepen out. So the other big position, and those two combined for about 40% of the portfolios that I'm in, are reflected in a long 2-year and a long steepener framework.
Is there anything that we haven't covered that we should have?
As I said, I think the biggest thing people should be aware of is very careful interpreting the data that you're receiving right now. Be very aware that those who are making decisions that have large macro impacts are looking at data and presuming it's high quality when I think it's actually very low quality. Now, I could be wrong about that. I just want to be clear. I don't think I am. I think the evidence that I've shown is pretty compelling. And so I would just encourage people to be more cautious and less willing to embrace the FOMO dynamic. Longer term, I do think a lot of critics and a lot of people who are concerned about ultimate response being even more aggressive this next time could very well be. So, could very well be right. I'm sorry. So, like, I'm trying to think through all of these dynamics, but the next stage in the process to me is an acceleration of the deflationary and recessionary action. By and large, I think we've avoided so far.
Inflation is not a linear phenomenon. It doesn't go up and then go down in a linear fashion. There are events and things that can happen that can cause inflation to be volatile. Exogenous things can happen, like the war in Ukraine. But are we? The idea of MMT sort of very quickly went away. Or yield curve control, I guess. But what I want to ask you is, are we sort of doomed to a range bound period where inflation comes back, the Fed hikes and then cuts, and inflation goes away, and then the Fed we return back to this sort of benign low interest rate environment, and then inflation rears its ugly head again? Are we in for a period of range-bound, inflation expectations from low to high because the Fed also has a balance sheet to manage?
Well, I wouldn't put the because the in there. I think,
or the Treasury. I mean, Sorry. Anyway.
So a couple of quick things. One, you mentioned MMT and the fact that it's disappeared. MMT has not disappeared. MMT is actually true. It is the right way of describing the monetary system as we have it today. As I've said repeatedly, MMT is descriptive of the system, but it is not prescriptive. In other words, it tells you how the system is.
Okay.
It doesn't tell you what to do with that power. Right? It's the equivalent of me saying to my, here's the ignition, here's the gas, here's the brake, here's the steering wheel, here's the shifter. And then saying, okay, now drive yourself to school. Doesn't work that way. You
Right.
have to actually take time learning how the system works. You have to feel your way through it, etc. The policy arguments behind MMT were always stupid, right? Of course, debt matters. Of course, spending too much money matters. It manifests itself in a variety of ways. We've seen the impact of spending it in stupid ways. If we hand out money to people for doing nothing, we should not be surprised that they put a strain on the supply chain by buying stuff without contributing. Right. On the flip side of that equation, we're probably in the blowback mode right now, where nobody wants to spend money on anything because they're so afraid of what just transpired. And as a result, we're going to end up in a situation that, as I pointed out, I think we could very well have even more inflation going forward as a function. But I think the most important thing to remember, and I'm going to share one last chart to finish this off, is that the underlying story is actually one of deflationary conditions relative to the world that we've lived. And I just want to orient people to this chart. So the blue line is what's called the engram, or the frequency of the word commodity in English language books. Right now, commodity is a word that dates back to Latin, been around forever. And so to see this type of surge in the use of the word is actually pretty remarkable. The orange line is population growth on a percentage basis across the globe. The 20th century that we came into and have now exited, right? Just to be very clear, from 1900 until 2000, and if I'm being very precise about basically 1870 until roughly 2000, was a period of unprecedented population growth. Truly, in the history of the world, nothing like this ever happened. We went into the 20th century with about 1 billion people in the global labor force. We came out of the 20th century with about 5.5 billion people in the global labor force. And remember what being in the labor force actually means. It doesn't mean that I drive disinflation. It means that I drive consumption, because the only reason I go to work is if I want more.
Right.
Right. So what we actually had was an uninterrupted period called the 20th century in which global wants exploded. And that was uniquely inflationary in history. We're now coming out of that. If I look at the 21st century and I use reasonable population estimate, the global labor force climbs from about 5.5 billion people to about 6.2 billion people. It's slightly higher than that at its peak around 2040, but ultimately begins to decline towards the back end of the century. And we actually end up in this really weird place where we have almost no population growth at all. How do you have inflation under those conditions? You don't.
Mm-hmm.
Right? We go back to a world in which basically prices remain relatively stable because the quantity of land per capita, the quantity of anything on per capita basis basically stagnates, and technology, which is deflationary, increases our ability to deliver goods and services to that finite population. This is Japan. This is South Korea. This
Right.
is the world that we inhabited in many ways, beginning in the 1990s around different regions of the world, right? So I have a really hard time getting that worked up about inflation in the Ben Hunt sense, except for stupid policy choices where we decide to spend money on really dumb things. And I'm going to say, the most horrific and horrible thing that I can say is that among those, our policies offer very little benefit to our population. I lied. I'm going to pull in one more chart here. And just show this here, because this is also part of some of the stuff we've been working on. So this is looking at the dynamics of government programs, the net cost of the program versus the age of the recipient or the age of the beneficiary. Age is here on the x-axis.
Okay.
The net cost is on the y-axis. You'll notice something. Things that are designed for children, those under the age of 20, actually have a positive return to the government. They raise future tax revenues more than the spending. Adult health does absolutely nothing for us. Unemployment insurance does very, very little. Why? Because those who are unemployed are literally using it in lieu of savings that they should have accumulated, right? So
Right.
it does absolutely, like we can lay out this type of stuff. We can start to say, what is the intelligent way to spend the money that we have under an MMT framework? That's not what we did, right? I mean, what we did was we basically jammed up. The other thing we're jamming up right now, by the way, New York State just announced that every single beneficiary in New York gets full nutrition. Congratulations. Among the most wasteful
Wow.
things you could have done, Captain Puctual. So, this is unfortunately the world that we inhabit a world where people tend not to be very thoughtful. They tend not to, try to be very quantitative. And that's both an opportunity and a disaster in process.
Yeah. So only the items that are in the yellow box are productive, and especially the child benefits.
Yes and no, right? I mean, everything follows a diminishing marginal return, right? So child health, probably the single best thing you can do. Child education, college available, children, etc.
Right.
These are all things that are meaningful contributors to future benefits and future tax receipts. But if I decide that I'm going to spend an unlimited amount on every single child, that's going to have a diminishing return and eventually will push that program up so that it is not profitable for the government.
Right.
Figuring out where that is a challenge. That's what economics should be focused on instead of a lot of the pontificating that you've heard me do for the past hour.
But the idea, it was interesting because the idea was being floated around in the campaign by, about universal basic income. And, that would fall into the category way up in the white side, way up in
Correct.
the top. Yeah.
Lot of money spent, not a lot of return associated.
Yeah.
Better policy, by the way, is straight from MMT's originator, Warren Mosler, is something along the lines of a job guarantee that says if you want to participate, you are guaranteed the ability to participate. Right now, do employers like that? No, because it means that they have to now compete for those employees with alternate programs as compared to people forced to seek employment, which, by the way, we've turned into a form of indentured servitude. People need their jobs in order to get reasonably affordable health care, among other things, right? So, we need to do a lot of work in balancing the scales. We need to improve the services that are available for children. We need to improve the services that are available for young families to encourage them to have the opportunity to successfully raise children. When we do all that sort of stuff, that's going to really help us a lot.
Mike,
but it's not doing it yet.
Fascinating stuff. Thank you so much for your incredibly valuable time. And
I appreciate that you think it's that way. I occasionally don't feel that way, but thank you very much, Pierre.
Only you would know.
What's that?
Only you would know.
Well, I have better insights.
Yeah.
Anyway, this is fantastic. I really appreciate your flexibility. For those who don't know, I had to push Pierre off from a recording earlier today. He was very generous in allowing me to reschedule. So.
Well, the feeling's mutual, Mike. Thank you so much.